If you're a young Australian seriously looking to build your wealth, you're probably deciding between two main investment options, ETFs or property. This is always a hotly debated topic amongst Australians, but too often I see people make the wrong decision for their situation and it leads them down a path of complexity, frustration, and because of this, poor results. So in this video, I want to take the time to go through what I normally talk to my clients about when they're deciding between these two options, the pros and cons of each, and specifically what you need to know about the changing playing field in 2026. We all know the backstory. Australians have had a love affair with property for decades, and for a very long time, it's been considered the way to build wealth in Australia. Property prices in major cities have soared and a lot of wealth has been built off the back of that. But in the last 15 years, Australians' ETFs have also exploded in popularity and shown really strong long-term growth. Plus, they're simple, you can start with any amount of money, and the best bit, the toilet never gets clogged on an ETF. In 2026, this debate between property and ETFs is only getting hotter because now the investing landscape is changing for both assets. Property investors are dealing with higher interest rates, tighter lending standards, increased holding costs, and tightening tax laws. The cost of buying an investment property has also risen dramatically, with many investors needing to save a substantial deposit before they can even get started. At the same time, ETF investing has never been more accessible. Brokerage costs are lower than ever, investors can automate their contributions, and gaining exposure to thousands of companies around the world is now only a few clicks away. But ETF investors aren't operating in the same environment they were a decade ago. Recent and proposed changes to tax rules, including changes affecting capital gains and investment structures, mean investors need to pay close attention on how their portfolios are managed and the after-tax returns they're actually keeping. Let's talk about the pros and cons of each and who each investment class is more suited to. Let's start with ETFs. Over the past decade, ETFs have gone from being a very niche investment product to one of the most popular ways Australians build their wealth today. Millions of Australians own ETFs, either directly or through their superannuation, and it's not hard to see why. The first major advantage of ETFs is diversification. When you buy an investment property, you're typically making a bet on a single asset in a single location. If that suburb underperforms, vacancy rates rise, or local conditions deteriorate, your investment can really suffer as a result. ETFs work very differently. Rather than buying one asset, an ETF allows you to buy a small ownership stake in hundreds or even thousands of businesses in one single transaction. This means that if one company performs poorly, it's unlikely to have a significant impact on your overall portfolio. The second advantage is that ETFs are incredibly low maintenance. The one thing many investors underestimate about property is how much work it can actually be involved behind the scenes. There's inspections, repairs, insurance renewals, maintenance issues, property managers, and paperwork. ETFs eliminate almost all of that. Once you're invested, your primary job is simply to continue building your portfolio going forward. For busy professionals, business owners, and families, that simplicity can be extremely valuable. Another major advantage is the low barrier to entry. One of the biggest challenges facing aspiring property investors today is simply being able to get started. In many parts of Australia, saving a deposit can take years. Then once you've saved the deposit, there are additional costs like stamp duty, legal fees, and loan establishment costs. ETFs are completely different. You can start investing with a few $100s and begin building wealth immediately. Rather than spending years saving for a property deposit, investors can put their money to work from day one and start benefiting from compounding returns. Liquidity is another huge advantage that often gets overlooked. Imagine you've built a portfolio worth $200,000 and suddenly need access to $20,000. Maybe an opportunity comes along, maybe you want to renovate your home, or maybe life simply throws you an unexpected expense. With an ETF portfolio, you can sell a portion of your holdings relatively quickly. Property does not allow that flexibility. If you need access to equity, you typically need to refinance or potentially sell the entire property. Having the ability to access capital when you really need it is incredibly valuable. ETFs also make it very easy to dollar cost average. This simply means investing regular amounts over time regardless of what the market is doing. Every fortnight or every month, money can automatically flow into your investment portfolio. When markets are high, you buy fewer units. When markets are lower, you'll buy more. Over long periods, this helps remove much of the emotion that comes from investing and allows investors to steadily build wealth without constantly worrying about whether now is the right time to buy or not. For many Australians, turning investing into an automated habit is one of the most effective wealth building strategies available to us today. And finally, ETFs also have a very strong long-term track record. While share markets can often be volatile in the short term and past performance does not constitute future returns either, global equity markets have historically generated attractive returns over long periods of time. Investors who remain diversified, continued investing consistently, and ignored short-term noise have generally been rewarded for their patience. That doesn't mean there won't be market crashes or periods of poor performance either. There absolutely will be. But history suggests that disciplined investors who stay invested, allow compounding to work for them over decades, have often achieved excellent results. So when you put all those pros together, it's easy to understand why ETFs have become so popular today. For many Australians, particularly those who value convenience and want a hands-off approach to their investing, that's a very compelling proposition. But look, ETFs aren't perfect either. Because they're so easy to buy and sell, some investors actually trade too much, jumping in and out at the worst possible times and letting emotion undo all of that compounding. There's no leverage in a standard ETF portfolio the way there is in property, so your money generally only grows on what you can actually contribute, not a much larger borrowed amount. And while the volatility is normally healthy over time, watching your balance drop 20 or 30% in a downturn can be generally confronting if you're not mentally prepared for this. The pros are strong, but they can only pay off for the investor who is mentally prepared to stay the course. But we can't forget about property. Property has created enormous wealth for Australian families over the past few decades, and for many people, it's still considered the gold standard of investing. Why? The biggest advantage here is leverage. This is arguably the single biggest reason property has been such an effective wealth building tool. Let's say you have $100,000 to invest. If you buy ETFs, you can invest $100,000. But with property, that same $100,000 might be enough for a deposit on a $500,000 investment. If that property rises 10% in value, you've made $50,000 on your original $100,000 deposit. But if you had invested that purely in ETFs, that same 10% return would have only made you $10,000. This ability to control a much larger asset with a relatively small amount of capital is one of property's biggest advantages. Property also creates what many people call forced savings. Unlike ETFs, where investors must choose to keep contributing, a mortgage creates a structure which forces regular payments and gradually builds equity over time for the investor. Then, of course, property can also generate rental income while offering potential tax benefits depending on the investor's circumstances. While the government is currently shaking up tax advantages related to negative gearing, deductions relating to interest expenses, depreciation, and other holding costs have historically been part of the appeal for many property investors. Another unique advantage of property is the ability to add value yourself. If you buy an ETF, there's very little you can do to influence the performance of the underlying companies. Property is different. Investors can renovate, improve presentation, add bedrooms, subdivide the land, develop sites, or improve rental returns through active management. In some cases, investors can create value through their own decisions rather than simply relying on market appreciation. Property also benefits from scarcity. Certain suburbs, school zones, coastal locations, and inner city areas have genuine supply constraints that can support long-term property values. The scarcity is one of the reasons many investors continue to view property as an attractive long-term asset. However, despite all of these advantages, property is far from a perfect investment. One of the biggest risks is what they call concentration risk. When someone buys an investment property, a large portion of their wealth is often tied up into a single asset location in a single suburb within a single city. If that particular market underperforms, the investor has very little diversification compared with the broad ETF, where your money may be spread across hundreds or even thousands of companies operating all around the world. Property also comes with significant upfront costs. Before you've even received your first dollar of rent, there may be stamp duty, legals fees, inspections, loan establishment costs, and other transaction expenses. Those costs can add tens of thousands of dollars to the purchase price and represent a meaningful hurdle for investors trying to get started in this investment class. Liquidity is another challenge. If you need to access money quickly, property can be difficult to work with. You simply can't sell part of an investment property. Accessing equity often requires refinancing, additional borrowing, or selling the asset entirely. This lack of flexibility can become very problematic if your circumstances change unexpectedly. Then there's the debt risk. Remember the leverage that we spoke about earlier? It's actually a double-edged sword. While leverage can absolutely magnify your gains, it can also magnify your losses. If property prices fall or if interest rates rise significantly, investors can find themselves under financial pressure very quickly. Property ownership also comes with a lot of ongoing responsibilities. Tenants could move out, things can break, insurance premiums rise, and maintenance never completely disappears, unfortunately. Property managers can certainly help here, but owning a property still requires time and attention. And finally, property can be emotionally stressful. A large mortgage, fluctuating interest rates, vacancies, and unexpected repairs can all create anxiety for the investor. Because so much capital is often concentrated in a single asset, property investors can sometimes find themselves carrying significantly more financial risks than they initially realized. And that's really the key takeaway with property here. It has the potential to accelerate wealth creation through leverage, but that increased return potential comes hand in hand with greater complexity, responsibility, and unfortunately risk. Property can be an incredible wealth building tool. Just remember that leverage doesn't only magnify your wins, it can also magnify your mistakes too. So after looking at the pros and cons of both investments, who does each option typically suit? In my experience, ETFs tend to suit people who value simplicity and flexibility. They're often a great fit for busy professionals, young investors who are still building their savings, or anyone who wants a hands-off approach to wealth creation. ETFs also make sense for people who don't yet have enough capital for a property deposit, or simply don't want that responsibility that comes along with owning real estate. Property, on the other hand, often suits people with higher incomes, stable employment, and a greater willingness to take on debt, because leverage is such a powerful part of the property equation. Investors need both the borrowing capacity and the cash flow to comfortably service that debt. Of course, these aren't hand-in-hand rules. I've seen high-income earners build significant wealth through ETFs, and I've seen young investors successfully use property as their primary wealth-building vehicle also. The right choice ultimately depends on your goals and your financial position, your risk tolerance, and the amount of involvement you want in your investments as well. But with that said, to finish the video, I also wanted to share with you the path that I see most of my clients take, because while this isn't suitable for everyone, it is a strategy I see most people use towards building their wealth. And here's the most important thing I can tell you. For most people, it was never really an either or sort of decision or situation. The clients who build wealth most reliably don't necessarily pick a side. They sequence the two assets over time, so each one does the job that it's best at. It usually starts with getting your foundations right. Before any investing, that means a cash buffer for emergencies, the right personal insurance in place, and any high interest debt like credit cards cleared away. It's not glamorous, but it's the thing that stops a single bad month from undoing years of good work. From there, most people start with ETFs, and they start early. Even small automated contributions every pay cycle get compounding working from day one. And they build the single most reliable habit in investing, which is consistency. The beauty of this stage is that the money is doing two jobs at once. It's growing wealth in its own right, and because it's liquid, it can also become the foundation of a potential future property deposit when the time is right. Then, as income and borrowing capacity grow, that's often when property now enters the picture. For a lot of younger Australians, that first step is actually their own home often, rather than an investment property, because that's where the forced savings of the mortgage and the leverage really start to work in their favor. And finally, once that's established, the most successful clients tend to run both strategies at the same time. They keep contributing to their ETFs for diversification and liquidity, and while their property quietly does its work through leverage and time. From there, more advanced strategies like debt recycling or boosting superannuation can also come into play to make the whole picture more tax effective. So the path I see most isn't ETFs versus property at all. It's potentially ETFs first to build the habit and the foundation, property next once the position supports it, and then both together over the long haul. The right version of that will depend entirely on your own circumstances, which is exactly the kind of thing which is worth mapping out properly before you get started and reviewed over time. And with that said, if you feel like you're on the fence between ETFs and buying an investment property, and you'd like to get some further advice for your own personal situation, feel free to book in a call with myself or one of our licensed financial advisors. The details can be found in the description and the pinned comment below. The first call is completely free with zero obligation to go ahead, and we're more than happy to see if we're able to help you or assist you with your financial journey. Thanks very much for watching.